Audio Trade. This is Don Kaufman, June 30th, 2021, end of the quarter, and more grinding trade. The big question from many a trader out there right now is this just some slow summer trade, or is it, a bit of volatility maybe forthcoming? Of course, you don't see any volatility in this marketplace right now. Let's get to work and evaluate a couple of aspects inside of not only today's marketplace. We're going to look at a bit more detail in terms of volatility. I think some of you guys really find this pretty interesting stuff. So the S&Ps closed on the session up a staggering 875. The NASDAQ down about 1250. As I like to say, well, that's massively unchanged. We've seen this kind of rotation, of course, into the QQQ, and specifically inside of the NASDAQ. If you take a look at the NASDAQ in terms of auto expected moves, and of course, I love to look at this because it gives more, I guess, statistical significance to just price action. And what you're seeing right now, well, is absolutely statistically significant. I mean, this thing is in effect been straight up. So a few weeks back over here, almost hitting the edge of the expected move, hitting the upper edge of the expected move. Obviously, last week closing on the edge of the expected move. Here we are on a Wednesday, literally at the edge of the expected move. Count them, people. It's effectively 4 weeks in a row that we're hitting the upper edge of the expected move. So you look at the NASDAQ and you think to yourself, what's holding the S&Ps back? I mean, yes, the S&Ps are to some extent migrating a little bit to the upside. What's holding them back, though, in very large part, happens to be none other than the financials. Now, this is something I point out just incessantly. The financials, if you look at the S&Ps on a year-to-date basis, okay, which we will in moments do, but if you take a look at the financials, they are what got those S&Ps there on a year-to-date basis. So the financials are up 26% year-to-date basis compared to the QQQ, which is up approximately only about 14% year-to-date basis. And again, to the S&Ps, as I was saying, if you take a look at the S&Ps on a year-to-date basis, up about 16%. So the point that I want to make with this one is the QQQ, which has actually been the underperformer, effectively has come to life, yet there's a rotation effectively out of the financials. For the time being, all that's really doing is stalling out the S&Ps. And again, everybody's like, oh, it's a blistering rally to the upside. Let's put a little perspective behind your blistering rally, if you will. Here is 30 days and effectively 1 hour. Okay, this is 1 hour candles over the last 30 days. And what do you have in here? Let me make this a little bit more clear, a little bit more concise on this front. You have a whole lot of trade that's been centered specifically around still about 42.11. Now, how far are we departed from the 42.11 handle, which is, again, all I'm saying is this 42.11, it's kind of been the central point, if you will, of trade. How far departed are we? Oh, come on, what's, 70, 80 S&P handles amongst friends. So it's a very mild departure to the upside. And again, just a few weeks prior to that, we made the similar departure, if you will, to the downside. So again, we're still, right stuck in the middle with you. And it's a little bit of a war between none other than the financials and, again, big technology. Now, what's also playing into that war a little bit are the bonds. Okay, the bonds, in very large part, this rally inside of the bonds, that's not good for the financials. So, in effect, if you see the bonds continuing to have upside gains, that's taking the interest rates lower. What you are going to see is, very likely that the financials continue to degrade a little bit. So the trade that's very, very persistent right now, and again, I'll cruise back over to the spiders in this respect. Okay, the trade that's really, really persistent is, for the most part, you have the NASDAQ in play right now. The NASDAQ is effectively straight up. The financials are kind of listlessly to the downside, and the S&Ps are kind of skirting right through the middle. And this is trade that, again, if I don't sound surprised at all, it's trade, but we saw the opposing trade, earlier on in the year where tech really wasn't doing anything. And again, financials were coming to life. Again, take a look at tech earlier in the year, nothing really going on. All of a sudden, big tech comes to life, and the marketplace effectively wakes up a little bit. So with that being said, again, one of the things that's also very apparent is I just wouldn't read too deeply into any of the day-to-day trade that you're seeing right now. And that is, I'm saying that because the volume is just, it's like non-existent out there. I mean, the S&Ps are lucky to do a million S&P futures contracts right now on a daily basis. Some of the trade that we saw like yesterday, the day before, again, you have to go all the way back to the holidays between Christmas and New Year's to see volume effectively that low. So again, just make yourself aware of what's in play right now, and it's all about financials versus, of course, the bonds, and financials versus, of course, big tech. And the bonds are driving a lot of the trade to the financials. Tech is kind of its own animal, ripping to the upside over here. But today, tech was a little bit softer. Maybe one of the stocks that you do want to keep an eye on right now happens to be Google. Obviously, its earnings are coming out July 29th. But the reason I want to mention Google, it is the top performer out of the monsters of tech, which is up some 41%. It's completely stalled out on a year-to-date basis. This is almost 3 weeks of trade. If you take a look at it in terms of expected move, sure, it rallied a little bit over here, but net, it is largely unchanged again in the last 3 to 4 weeks of trade. Keep an eye on it. Sign of Google rolling over would, of course, soften most of the NASDAQ. Now, let's actually come over to, well, again, answer the question, is this summer trade or is volatility forthcoming? And I have a very interesting perspective to give you on this one. If we take a look specifically here, specifically at the VIX. So I am not, again, I'm not a big proponent of looking at the VIX, but I looked back at the VIX, for example, for like the last 5 years. Okay. Clearly, the onset of COVID has changed a lot of parameters inside of volatility as we know it. Now, the VIX itself spikes and it's come down quite considerably. And again, I can't reiterate this enough. I mean, volatility feels just changed with, again, the onset of COVID, but we're now back down in this 15 or 16 region of the VIX. So I wanted to look back at previous years inside of the VIX and see, is there a degree, if you will, of seasonality when it comes to volatility? And this is something that a lot of traders have always talked about. Volatility kind of subsides in the summer. Nevertheless, if you look at last summer was absolutely unequivocally wild in terms of volatility. I mean, volatility spiked, obviously, again, with the onset of COVID, but didn't really back down and even get back to the 20 region until, well, August, kind of September timeframe before it rocketed back up, and even seeing the VIX back up at 40 in the October region. So for those of you that speak volatility geek, there are some very definitive things you can discern by, if you will, a little bit of seasonality in terms of the VIX. And to look at that, we're going to bring up again a very unique chart. So what you're actually looking at is a 10-year. Again, this is a 10-year on the VIX, but this is actually what we term a seasonality chart. And I'm going to just kind of take you through this. What you're actually seeing right down here, this is actually the average, okay? So that's an average over the last 10 years. So it's basically taking the VIX over 10 years and it's averaging it. There's actually some very cool ways to look at this. I'll get to that in just a moment. Right here, okay, this is actually the VIX. So this is VIX, and that's year to date. So you can see that the VIX year to date, it looks absolutely unequivocally nothing like the VIX on the average. So I just wanted to look at like seasonality for a moment, and I started doing so, and then I completely pulled back from this and said, wait a second. If you will, like the last 18 months, we've never seen any volatility like this, in this period of time. And then, of course, with what we're looking at in terms of a year-to-date basis, where the volatility is absolutely contracting in a year-to-date basis, okay, versus this average volatility. And again, what you will actually kind of surmise from this is I do not think that seasonality is going to have an impact whatsoever at this point in time. Nevertheless, volatility from what we've seen on a year-to-date basis is absolutely rock bottom. And before I actually pull off this VIX chart, because I just basically summed it up and said like, hey, listen, I looked at seasonality and I looked at it in depth, and I don't see any discernible pattern from the average to where we currently, where we are to the average looks like two totally different worlds. Take from, that what you will. So I can actually flip this around and just look at the yearly, hit apply, hit OK. What you're now actually looking at, if you will, is like, the last 10 years inside of the VIX. And it literally is just layering year after year after year so that you can look for some seasonality, impact over here. Now, I don't find this useful at all because year over year basis is pretty wild. Obviously, if you see this huge spike up here, this would be the onset of COVID. And looking at this is exactly why. It's exactly why I'm throwing out, okay, not only am I throwing out the average of the previous 10 years, because nothing, again, that we're seeing right now says that we're back to normal, okay? The COVID incident in volatility, if you will, is an absolute unequivocal standout in here. So back over to the seasonality, what I can do is I can take the appearance and flip it from a yearly. You can do yearly plus the average, hit apply, hit OK, and you can actually see the average in the middle of this. It's still an absolute disaster to look at. Or we can just come in here and just go to the average, hit apply, hit OK. And what this does is shows the average versus where we're currently at. And again, I wanted you to see at least what I see, and I'm just I'm going to imply this from looking at this, that the average means absolutely unequivocally nothing in this year. So from that, you're like, oh great, where do we stand? From that, okay, here's actually one of my assumptions. My assumption is that the current floor inside of the VIX is probably in and around the 16 level. Okay, just based on the fact that we have touched down into the 16 level a multitude of times. Okay, so why would I actually imply that, all right, maybe the floor in the VIX is somewhere right around 16? It has a lot to do with the fact that the SPX, okay, if you took a look at the SPX, and this happens to be a daily chart of the SPX, and you really started to dig a little bit into things like historical volatility in here, the historical volatility is absolutely rock bottom. And I'll pull up like historical volatility. The historical volatility is all the way down, and this is averaged again over the last 20 days. This is not hours, this is 20 days. This is daily chart, so this is historical volatility. Do you realize historical volatility, okay, is literally at roughly 8%, and implied volatility, or at least implied volatility to the VIX, is roughly sitting at 16%. My assumption is a very simple one, that the SPX, in terms of actual price movement is probably not going to descend much more than it currently has. It's already actually off of its bottom. That actual price movement is in effect going to start to pick up, which should also, okay, bring implied volatility back up. The one interesting thing about this is actual price movement is still, okay, over the last 20 days, actual price movement is still well under what the 30-day volatility says it is. Now, it's not a great comparison to use historical volatility versus implied volatility. Nevertheless, okay, it does give us the belief, though, that we've kind of hit rock bottom in terms of actual price action in the marketplace, and that we should see lifting, if you will, of overall volatility. And specifically, we should see the VIX lift just a bit here in the very near term. So with that, to kind of answer the question is, yeah, no, this is unquestionably some slow summer trade. Nevertheless, I do believe that some volatility will be forthcoming in the marketplace, and I would look probably towards the bond market to actually spark some of that volatility, where the S&Ps have been relatively flat. And again, we were bringing up the SPX just a moment ago, and we're looking like there's not even a discussion of the expected move this week because we've done absolutely nothing, right? So the one interesting thing on that, on the same front, is if you take a look over at the TLT and apply the auto expected moves, okay, the TLT is downright wild. Okay, so the movement is in the S&Ps is likely going to be generated specifically from the bonds. The bonds are a rockin', people. Do not forget that, and that's likely to spark some volatility inside of the broader S&P 500. Thanks everybody for joining us here at Theo Trade. Have a wonderful evening. Bye-bye.